Okay, let's talk investing. It's strange, isn't it? The basics, they're pretty simple, expressible in plain English, yet mention it at a dinner party, and often silence. People seem almost scared by it.
That's spot on. And it's exactly the paradox we're diving into today, using Richard Oldfield's book from 2007, Simple But Not Easy. His whole aim was pretty bold. Cut through the jargon, challenge the so-called wisdom from the pros.
And reveal that maybe success isn't about some secret formula, but more about temperament.
Precisely. About emotional discipline, really.
Okay, so our mission today is to pull out, let's say, 3 big lessons from Oldfield that really push back against how people usually think about investing.
Sounds good. Where should we start?
Well, how about with something that sounds almost counterintuitive? Embracing mistakes. Oldfield uses this family motto, Vulnere Viresco.
Ah, yes. Through my wound, I grow strong. He actually suggests that's the perfect motto for an investor.
Which implies errors aren't just possible, they're necessary, essential even.
That's the idea. Every mistake, every wound makes you fractionally better, more experienced. And these lessons can come fast. He tells this quite vivid story about Warner Communications in 1982. Shares collapsed.
Yeah.
And it happened the morning after his stag night of all times. But the key takeaway for him wasn't just the market move itself. It was about ethics, seriously unethical behavior, or even the perception of it. The market just doesn't tolerate it. Prices can plummet fast.
Regardless of the fundamentals before that.
Exactly.
Yeah.
Ethics matter for very material reasons. It trumps the balance sheet sometimes.
So does that mean your own convictions, your rational analysis can just be overridden? That sounds like a hard lesson.
It is. And he gives another example, Yukos in Russia.
Yeah.
Post-98 crash. The shares looked incredibly cheap on paper. A rational buy, you'd think. Then the unthinkable happened. Political strategy, Putin consolidating energy assets.
Right.
It just wiped out that rational case. Ruin for investors.
So the lesson there is never get too attached to your own logic. Be aware of bigger forces.
Never be too convinced your convictions are totally right, especially when politics or, sovereign risk is involved. The unexpected can happen.
Right. Okay, so if we accept mistakes and these external risks, what does that do to the idea of a safe investment? Oldfield seems to turn that on its head, too.
He really does. He makes safety about time. It's not just about how much the price bounces around day to day.
How does he illustrate that?
He uses this great comparison. Investing in really volatile Russia in 1997 versus buying, say, Coca-Cola stock around the same time. Coke seemed like the ultimate safe bet.
The classic defensive stock, yeah.
But over nearly a decade, it actually lost about 20% of its value, slowly, steadily down.
In Russia, I remember that period, it was chaos.
Total chaos. It fell something like 67% in just 3 months. Absolutely terrifying volatility.
But the long game.
Exactly. If you somehow managed to ignore that terrifying drop and held until 2005, you're up 270%.
Wow. So safe depends entirely on how long you can afford to wait it out.
That's his point. Safety isn't absolute. Volatility feels risky short term, but for the long-term holder, sometimes the safe stock is the one that quietly loses you money. He talks about the benefit of keeping your distance, like being Rip Van Winkle, sleeping through the panic.
Avoiding that emotional urge to sell when fear is highest.
Which is usually the worst possible time, often right at the bottom.
Which leads perfectly into the third idea, the danger of crowds, of consensus thinking. Oldfield admits his own worst mistake involved this.
Yeah, the October 1987 crash. He said when he was away on holiday, he looked at the market rationally from a distance and thought shares were actually cheap after the initial drop.
The correct distance judgment, as he put it.
Right. But then he got back to the office, back in the thick of it. He described this onslaught of opinion, just overwhelming gloom, everyone panicking, and he buckled. He went with the consensus, sold shares.
And the market then promptly rose, leaving him behind.
Caused severe underperformance. The lesson being that distance, physical or emotional, is a huge advantage. Avoid getting swept up in those big dogmatic market views.
This sounds related to what he calls information minimalism, the idea that maybe too much information is actually bad for you.
It is. Being too close, reacting to every news alert, every analyst report. It encourages short-termism. By the time news is published now, especially with instant communication, the market has usually already priced it in. Reacting to it puts you behind the curve.
So the advantage lies in stepping back, being skeptical of the noise.
Skeptical distance, yes. Don't just follow the herd.
Okay, so let's try and tie this together for you listening. It seems the core message isn't about finding some complex strategy. It's simpler, but harder. It's about emotional control, isn't it? Discipline to accept you'll be wrong sometimes.
And having the patience to look beyond today's panic or euphoria.
And maintaining that healthy skepticism towards what everyone else is saying.
Right. And that skepticism, that contrarian streak, is actually where Oldfield suggests the biggest opportunities lie.
How so?
Well, think about it. If his philosophy holds, the best chances often come when a stock is utterly despised, when it's seen as tainted, when the consensus view is overwhelmingly negative, extrapolating gloom way out into the future. Oldfield would suggest, hey, just maybe, that's precisely the time you should start looking to buy.
A final provocative thought indeed. When everyone else is running away, perhaps that's your signal to walk towards it.
If you have the discipline and the time horizon. Simple, but definitely not easy.